Alrighty, good morning, traders. This is Blake. Sorry, I was just closing out some of my dollar CAD from yesterday. For those of you that are not in the ForexAnalytix chat room, just so you guys can see an example of what I do, for example. And I just closed out some positions this morning. This is showing you my open running positions that I have, and I was just I was actually just typing all that out that I closed. Part of my dollar Canadian longs, as we're approaching some pretty key. Well, I think we're approaching some pretty key resistance. If you look at the dollar CAD and I'll kind of explain to you guys my thought process here is that we have a 618 retracement coming in around the channel resistance. You can see this is a 4-hour chart. 200 period moving average doesn't matter a whole lot. What matters more to me is like this horizontal resistance. As we come into that level and we breach new highs from yesterday, I want to be the guy selling it to everybody that's trying to rush in. That's the kind of way I trade the markets, is I try to get out on momentum when or at least take off some of my longs when there's some momentum behind me. So that's why I was just taking off partial. I do want to remove the rest of it a little bit later. If you guys were around during the Canadian CPI, I've been running this trade since a couple of days now. So anyway, that was from yesterday. We need to talk a lot about what's happening today. We've got FOMC meeting minutes. We have some housing data coming up. We had the CPI out of the UK come out. We had the RBNZ last night, which I'm going to be the first one to tell you guys, I completely spaced the RBNZ. Like I talked about it on the week ahead video. I just didn't have any New Zealand exposure. So selfishly, my mind just kind of blanked it out. And I didn't even look at the Kiwi until after the fact. It's interesting. I didn't hear a lot of people talking about it yesterday either, but we ended up getting a pretty decent move higher in the Kiwi, even though it was a hawkish hold. That was kind of what I even mentioned on the week ahead video. We're looking at hold, and it might be a little bit more hawkish, and we got that. But anyway, like I said, I wasn't paying too close of attention because I just didn't have any uh, New Zealand exposure. Which, like I said, it's a little selfish of me to thought that way, but and it is what it is. But like I said, today we do have the FOMC meeting minutes. We have a 20-year auction. We actually have a lot of housing data coming out. Nothing, nothing happening as soon as the face show is over. And by the way, as we transition into an interview, we're going to have a gentleman that I've actually been following him on social media probably for the last year. His name's Dale Brisco, I believe, and is his last name. He's not new to our show. He listens to our show quite frequently, but he's a new guest that Dale had scheduled. I'm excited, Dale Pinkert, that is. I'm excited to have Dale on today. Talk to him a little bit because I actually follow him on Twitter, and I have for a little while. So it'll be really nice to have him here. He's a hedge fund manager, or ex hedge fund manager, so he's going to be a really interesting person to talk to later today. So make sure you all stick around for that.
Yeah, hello everybody. I've been following him too. I really like the guy. I think he's going to be very interesting.
Yeah. Hey, Stel, and I think you will be too. And Stelios, since you spoke up and we haven't heard from you in a while, tell us a little bit about what you're seeing right now, as you have a little bit focus on the market in recent weeks. What are you keeping your eye on right now?
Yeah, well, the main theme is still who starts cutting first and how deep does it go. Problem is, as I said yesterday, with copper hitting new highs and commodities going higher, it's if they start cutting, they're going to be stoking inflation higher. So that's going to be interesting to see. Um, Today we had the UK CPI, which came in a little bit higher than expected, but still 2.3% year on year, so that's very close to the 2% target. PPI was lower than expected, so you could argue that UK inflation is going to target. I never thought I'd say that, but it's going towards targets. So it seems like the ECB and the Bank of England are going to be the first to go. But again, the question is, what happens to inflation and to all these, price readings going forward? Because if they start cutting and inflation starts going higher, how do the central bankers look? I mean, they can't look any more stupid, but they probably will.
Yeah, yeah. Well, and actually, I'm gonna circle back to that conversation here in a second because it's something that Kman was discussing here in the in the ForexAnalytix chat room just a little bit ago. But before I do that, I'd be remiss if I didn't say good morning to everybody that said good morning to me. So just real quick, good morning, Alexander. Good morning, Bran. Question: how deep of a dip would you wait on the pound dollar if waiting to go bullish? Well, you know what? We're going to answer that question in a minute. Good morning, AJ, Ryan, Ingmar. Hey, Stelios, good morning to you because you typed it earlier. Paul, Kman, Benedict, my good brother out of South Carolina. Shriv Prasad, good morning. Mr. Michael W. Good morning, Andrew, Kurt, and yeah. So we got a question from Brand. Said, what would we be looking for in the sterling to go long? And let me just throw in my 2 cents, and then I want to bring in Ryan really quick to get his thoughts on the UK CPI. I think it was Kman that actually forced by absolute force, made me look at this trend line, a descending trend line. I believe it was Kman. I may be mistaken here, but anyway, we're getting up towards the 78% retracement. It looks like we have some sort of triangle consolidation here, so it's going to be a little bit of time before I get bullish. Me personally, I might maybe look for a dip to 136.30, but let's get somebody that's got boots on the ground in the UK and hear his thoughts. Ryan, what are your thoughts about the CPI that came out overnight or during your day?
Well, it's Willie boots on the ground at the moment because he's absolutely heaving it down here. Yeah. Well, it's as expected. It didn't drop as much as everyone thought it would be. The headline came in at 2.3, expected 2.1. The core came in 3.9, expected 3.6. So an upside beat there, and the pound rallied on that. But the wider context is it still is a chunky drop from on the headline number from last month. So it is going the Bank of England's way, though that core number is a bit sticky. The market's done its usual jiggle around. June seems off the table. August is gaining in favour. And the pound is a bit better bid. KY had a rally, but that's now pulling back in the face of some dollar strength. And euro sterling is hanging around that big 85 level.
Yeah, we got a little bit of a breakdown in the euro sterling here, and it looks like we're going to be targeting this 127% extension. I mean, do you chase the short side of the euro sterling here?
Not above the 85, no, definitely not.
Okay,
break,
all right,
maybe, but not not down here. This is a years old support area.
So let me ask you this from a trading point of view. I mean, is this one of those situations where you just go long and then you put a stop and then you get a stop and then you put in a stop and reverse to go short on a break below 85, or you just wait to see how price action develops around here? What are you going to do with the euro sterling down here?
Well, I'm still long from July last year, and I keep adding down here and offering it in the rallies. And I was buying it again this morning, 20s and 15s, and I got a bid in at 10 and down to the big figure. So I'm on the news from the CPI. I'm happy to buy it. If we were trading around 20s when that number dropped, we probably would have gone through it. So I'm still confident in the level. I'll just decide. I'll watch the price action, as you say, and decide whether I want to flip my stops below 84.80 to a short, because I think if it does break, it's probably got some legs, but it's going to need a fundamental reason why it breaks rather than just a stop run that might happen.
Yeah, I mean, because and could it have been the UK or the CPI data? Maybe it wasn't strong enough to quite elicit that type of a response. But that brings me to some other question that, you know, Kman, and this is a Stelios Kman conversation that I can bring you two gentlemen in with. You know, Kman, you were in the chat room a little bit earlier today in the ForexAnalytix chat room talking about the weakness of the euro, and maybe that people are finally you know, coming to grips with the idea that the ECB might be the first, well, that they're probably going to be the first central bank to cut. And that is something you started talking about, you know, when I got up this morning. By the way, Benedict, you said you're in North Carolina. Just remember, it was actually just 12 minutes ago. It was a 4 o'clock hour for me. So yeah, North Carolina. Sorry, buddy. I know it's pretty offensive from North Carolina to South Carolina as well. So anyway, back to my question to Kman and to Stelios, euro breaking down. What are your thoughts here, Kay?
Well, I wouldn't call it breaking down, but I think the euro has been living on a bit of borrowed time. Being bid through various crosses, euro sterling for a while, then euro yen, euro Swiss, you name it. And I don't know. I mean, Lagarde again confirming yesterday that June is the time where they are going to cut, barring an abnormal shock somewhere. I could see just you know, staying heavy. I'm not looking for like big breakdowns, but just remaining a bit heavy, because they will definitely go before the Fed. So perhaps the euro dollar is slowly starting to feel a bit of gravity setting in, you know. And we also had a bit of a confirmation to cap around at 109. This is helping as well. So, and I think if we get through low 108s, we can just, you know, lose again what we took over the past month or weeks or so. That is my idea about it. Of course, we've got PMIs coming out starting tomorrow, so they may change the picture a bit. We are still in very slow ranges because the option volatility is getting absolutely trashed. But no, it just looks a bit heavy to me, this euro dollar right now, and perhaps towards the end of the week if we don't see anything spectacular on the PMIs.
You know, and you're right. PMIs tomorrow are going to be, and it's going to have a big impact on the euro dollar, so to speak, because one of the bigger ideas of earlier this year in early 2024 was the U.S. exceptionalism story. So having we're going to have Euro PMIs, UK PMIs, which could obviously have an influence on the euro sterling. And then the U.S. PMIs will come out about this time tomorrow as well. So a lot of data that could really move the needle here. But you know, taking a step back, and this is probably a good place to bring in Stelios here. You know, looking at the euro, we are in a big, as far as I'm concerned, in a big triangle formation, and it's a nasty one too. You know, 110 to 106.50. We're smack dab in the middle of the apex of the triangle. What do you make of the euro here, Stelios?
Good question. It depends on what the ECB is going to do. They've basically almost announced that they're going to be cutting in June. A lot of you know, eurozone data has not been great. ECB has been dovish. So for the moment, you know, given everything that we've had, I would have assumed that the euro dollar would have been lower, you know, testing the bottom end of that triangle. So my gut feeling is, again, also because I think yields are going lower, my gut feeling is that we're going to be testing the 110 area before reversing. That's what I think is going to happen. I think yields are going to be rejecting these current levels. The 10-year US is going to be dropping below 434, which is support, and that will probably bring the euro dollar towards 110. After that, I can't tell that for forward. But you know, if you ask me, I think most likely we hit 110 first, and then we go lower.
You know, I'm not really. I'm going to say I'm going to agree with you here. I wouldn't want to disagree with you. I think the euro's path to least resistance is still higher, but today has been kind of this has kind of been a little bit of a setback technically, but you guys should really just pay attention that this is a daily chart, right? Look at the 50 DMA and the 200 DMA. Look at how close it's wound up. It's like braided. Like you don't see that often. I mean, scroll out on the euro and look at the last time that we've seen this type of braiding in the in the euro on a daily chart. You're talking way back in 2016. So this is a very, very tight consolidation, but I'm kind of with you. I'd rather sell the euro at 110 than at current levels. So, maybe this is going to be more of a product of US data starting to show a little bit of weakness in the coming months that might be the catalyst that drives the euro up there. Maybe that's it. Hey, I want to go back to Ryan. I think would be a good person to ask this. In the chat room today, just a few minutes ago, Father Ted, let me find him. He brought this up about, I don't know, it was about an hour ago. About 30 minutes ago, talking about this possible situation with Sunak. And then also Scott just asked the same question regarding like a snap election. What do you think here would happen? What's happening politically? Fill us all in, that those of us that are dumb Americans. We're not paying attention. What's going on?
This is the rumor going around. I don't think it's that much of a big deal. We know an election's coming. We know there's going to be a change of government. Sunak needs a Hail Mary to win the election. Trading wise, I don't think it's going to affect the pound too much. What will happen after we finally get a date, we'll probably start the political trading. Is the Labour Party going to get a majority? Is it going to be a hung parliament? The standard form is market doesn't like uncertainty. So if Labour do win and they win strongly, pick up a majority, then we move on. But if it's looking like it's going to be messy, then that's probably going to hit the pound, because, as I say, the market investors, they don't like political uncertainty. But calling the date, we've been waiting for it long enough, so it'll be about time.
Okay, so basically, we need to be watching like who the coalitions are going to be.
Yeah. Firstly, if there's no majority, which obviously we're not going to know until we start getting a load of polls coming out and whatnot, then that's when the pound might take notice. But coalitions are going to be tough. Because no one wants to do business with anyone else.
You guys have leadership changes almost as frequently as my teenage son changes his underwear over there. It's crazy.
It's been
it's wild.
Yeah. All right. Very long.
What's that?
I was saying, it's been a very long time since we've had a change. So we never know. At least we're not like Greece. They used to have a revolving door on.
Hey!
True that. All right. Hey, let's talk a little bit about today. So today we got first of all, we got Nvidia earnings. I'd be silly not to take a look at Nvidia, which is really driving the market here. We are, in my opinion, we're developing a bullish wedge. Now, a bullish wedge is just when you have consistent highs, higher lows. That tends to lean more in the bullish direction. So, but I'm gonna also, say that right now the market has very high expectations for Nvidia earnings. So, even a beat could give us a buy the rumor, sell the news type of event. Just based on the ridiculously high expectations of tonight's earnings. That's obviously going to put the stock market in view. And if you look at the S&P, and by the way, these are your breakdown points. You can see them very clearly here in Nvidia. Tomorrow morning is going to be really important. Not so much after the market close, where the market opens tomorrow is going to be really important. But if you look at the S&P is still sustaining this 5280 level. I think this is the green line you can see here. While you're above not this green line. Let me remove that one. Let me remove this one too. While you're above this green line, there's no reason to be bearish, other than just understanding that volumes have tapered off quite dramatically on this breakout, which by default is a very big risk for bulls. but price also suggests that there's no reason to be bearish while you're, above this 52.80. The fact of the matter is, in the event that we get some sort of sell-off, there's going to be plenty of downside. You don't need to be the first one to stick your toe out right now to be short, when you're breaking out to the upside. You just got to respect what we're seeing in price. There are risks, divergent relative strength, low volume, all that other stuff, but we need a catalyst, and maybe an Nvidia not so hot earnings would be a catalyst that would drive a little bit of profit taking in the S&P. But just understand that very, very, very key levels here. Also want to turn your attention to the German DAX. The German DAX has a head and shoulder pattern developing, and we hadn't reached for channel resistance, which I thought we would reach above 19,000. But just keep an eye on the DAX. If we get below 18,550, that's going to be kind of bearish there. And if you take a look at like what's happening in the NASDAQ 100, very similar type of situation. Rallies, low volume. You can see volume is tapered off quite dramatically, and but still holding our breakout points. So a couple key things happening here. We also have the FOMC meeting minutes. I personally think the minutes are very important right now. I think minutes from any central bank, given the fact that we are really just trying to figure out, is the Fed, ECB, the RBA, this week when the RBA had its monetary policy meeting minutes, are we closer to cutting rates? Or is the Fed going to keep rates unchanged? Being able to see behind the curtain, if you will, from the Willy Wonka factory is going to be pretty important. I just got Willy Wonka and Wizard of Oz just mixed up there, but do keep in mind it is 5 o'clock in the morning here. So, but being able to see behind the curtain of the Fed is going to be fairly important in my view. So getting some of the governor's comments, some of the Fed governor's comments, written comments on how they feel about monetary policy, going to be fairly important. However, we've seen a parade of Fed speakers all week long earlier this week too. So Ryan, do you have any thoughts going into Kman, do you have any thoughts going into the FOMC meeting minutes today?
No, absolutely not. I don't see what they can bring to the table. Fresh news, anyway. I mean, we've heard of all of them. I really don't see where there could be any surprise coming out of that.
The flip side to that is, sorry, I was just getting a sip of my coffee here. The flip side of that is that we also have to keep in mind that the market is grasping for something to trade against.
Oh yeah, I mean,
too. So. Yeah.
Any weak data the market wants to see to call for the Fed to start cutting or to pivot for real. I mean, the market is dying for reasons, but I mean, for as long as they don't get any of those reasons, or not too many of those reasons, well, anyway, let's say the minutes should not show any surprises in my opinion, because we heard from all of them.
Yeah, right. Yeah, exactly. They've been parading around, spewing out their verbal garbage all week long. So maybe we won't get anything
guys,
new.
Sorry to interrupt. I remember years ago when I was trading in London, and whenever we had the Fed member speaking, it was an event. Nowadays, it's like, oh, Kashkari is talking, 10 times a week. So it used to be very important because they give you an insight. Nowadays, it's like you have it, 5 times a day. So
yeah, you're right. I mean, the Fed, I think, has gotten to a point where the communication efforts are ridiculous. Should I say that? I mean, they which was it Bernanke? Was it Bernanke's Fed that actually started to really communicate? I think that's about right? Ryan, do you remember?
Yeah, I think it was after the crisis, and they were so scared of things blowing up. They were out a lot, forward guidance and all that sort of thing, guiding the market. I'll tell you what, if we had sex as many times as these lot speak, we'd all have smiles on our faces every day.
Speak for
Maybe I'd
yourself,
be the
mate.
one saying, I'm
Yeah,
sorry, I
yeah,
got ahead of
exactly. What does that you have to do around here? I'm with Stella on that one.
All right. Hey, let's all also keep in mind we have some existing home sales. You can see those are coming out today. Don't expect anything here in the U.S. I mean, they're going to be miserable. Rates are high, inventories are low, no one can move. I mean, it's the same old story here in the U.S. Any type of surprise would be, shocking. And I tell you what, if I was a home builder here in the U.S., I would be making hay. And the home building index, you look at Toll Brothers, their earnings are great because they're just pumping out housing, and they're giving all sorts of, for new houses, they're giving all sorts of deals to get people in. So it makes a lot of sense. Hey, speaking of the dollar, since we, this is something that I've been, recognizing all week. I don't think my numbers have changed at all for the dollar index. We're stuck in a 104 to 105 range, basically. And you can see it. We're getting towards the upper end of your range around the 105 level. In the event that we reach up to 105 today, as you talk about what Stelios was mentioning earlier about the euro going up towards 110, this might be an opportunity to be on the long side of the euro. And I say that because remember, we do have euro PMIs tomorrow. But do you have any color on eurozone PMIs, guys? Do you think that they may be a little better or worse than expected?
Who knows? I mean, the data's been disappointing recently, but I don't know. I don't have a view. Actually, before Ryan and Kay give their opinion, another thing I want to add about the euro dollar going to 110. I still think the path of least resistance for equities is higher for the near term, and that usually means that euro dollar is usually correlated with that. So I think if equities go a little bit higher, so does euro dollar.
On the other hand, we have done 250 points in equities without a real move on the euro dollar, right?
So you're telling me that the euro dollar is lagging and needs to catch up. I get it. Okay.
Well, yeah, but you could
No,
argue
but I
the
mean,
same.
and the thing actually regarding the European data is that we actually got a little of very, very small green shoots of late. So tomorrow they are expected again to show slightly better numbers, even though on the manufacturing side it's still going to be weak, but the services are expecting to show slightly higher numbers actually in the Eurozone. So the surprise trade would be that they come in weak again, and that would really cement, I think, the June, if already needed, cut, and may actually. I think the surprise trade for tomorrow is our lower PMIs, and if that happens, then the euro could really get a knock on the head.
Yeah, that would be a bit of a surprise, because I think a lot of people are expecting eurozone PMIs to really continue to stabilize. But just highlighting the fact of what you're saying, Kman, the euros had very limited upside. So is the Aussie, and even with copper's finally showing a little bit of a reversal today. So with copper showing a little bit of a reversal, the Aussie's not looking so hot either, and you can see this is a 3%. Reversal in copper, from the previous all-time highs here, and that's starting to weigh on risk a little bit. So, and we haven't. I thought the Aussie would act a lot better in this environment, and same with the euro. Just thinking about dollar weakness. Okay, we have about a minute. Dale Brisco's coming in. I don't since he's new, I don't want to take up too much of his time, but I would like to go around really quick. With you guys, Stelios, what's on your radar today that you're looking at, that you're keeping
I don't have a single thing in particular that I'm looking at, so let's move on to somebody else.
Okay, Ryan, what's on your radar today?
I'm monitoring what Stel's monitoring. No, I'm just managing positions. We've got a few pairs on key levels. Aussie dollars on its break point, 66, 40, 50. We've got a lot of assets pairs on break points, gold as well on 24. Some of these pairs need to kick on and crack these highs and continue the moves, or we're at risk of seeing a pullback. So that's what I'll be looking at.
All right, last but not least, Kman, what are you thinking today?
Just don't change the winning team. So the Swiss continues to gradually weaken. We are on a relatively interesting level there, 91.5 on the dollar Swiss. If we could get a break and a hold above, that would be constructive, I think. And the other one, this morning we had slightly lower Rand CPI and South African CPI, and I'm half afraid that I missed the opportunity yesterday to buy between 18 and 18.10 Rand, but any decent setback, I think I'm going to finally get my butcher's glove out and start to buy that thing.
You know, I've had a long last week. I got stopped out for a little bit of a loss when it broke below this. I got stopped right here near the lows. But yeah, I mean, if we get above 1830, I mean, maybe we get a little bit of a reversal. There is that election coming up, so it's gonna be an interesting one. So
yeah,
thank you. Go ahead.
I was really planning to wait for the election to really go into it, but the levels 18, 18.10, it's looking interesting in my opinion. So I might do just a small and then wait for that election and then press some buttons afterwards.
All right. Well, I appreciate you guys' thoughts, and I appreciate Stelios. It's nice to hear your beautiful, sweet internet voice, you know,
Nice to be here.
And Ryan and Kman, thank you guys so much for being here. And remember, you guys can catch Ryan and Kman on the shows, you know, on the Flow Show every single morning. And you guys, I'm going to say this again, make sure you take advantage of ForexAnalytix. Take the trial, $1 for 10 days, jump in our chat room, check out the app, download the mobile app, see what it's all about, because we have some exciting news on over the weekend. And by the way, it is going to be a long holiday weekend here in the US. We do have Memorial Day weekend, so we will not be broadcasting on Monday, just FYI.
It's a bank holiday here on Monday as well. So
what holiday is it for you guys? It's always a holiday there for you.
It's a Monday.
It's called an other holiday.
Okay, great. Awesome. Another holiday. Hey, cool. Well, we Monday we will all be off then. Just make sure you guys mark it down on your calendar. And with that being said, I'm going to bring in Mr. Dale Brisco. Dale, good morning. Welcome to F.A.C.E. And I know I'm not Dale Pinkert, but I'm Blake. Nice to meet you.
Good morning, Blake. Good morning, guys. How are you?
Good morning.
And I'm not a novice. I was on 3 months ago, so.
Oh, okay. You know what? I for some reason I was thinking this is your very first time. My mistake. Good to see you. And I know I've been following you probably for like the last year. And tell us a little bit about yourself and about your experiences in the markets, because you have quite a past.
I do. And if it suits you all, I'm going to share my screen if that's okay.
Absolutely. So here you go.
Okay, are we sharing now?
I'll let you know when I see it. I do not see your screen yet.
Me neither. Hello, Dale.
Hey, Stel, how are you going?
Very good, thanks.
Yeah, I still don't see your screen just yet.
Here we go.
Yes, now I can see
We have it.
your presentation.
Yep. Cool.
You know what, Dale? It's my bad. I do actually now. My memory's coming back. I do remember having you on here, and I sat through because it was your first time. So welcome back. My bad.
Thanks, Blake. And you're not alone. I'm getting to the age now where I can't even remember what I've had for breakfast in the morning. So it's it is that time of life. Anyway, I know that you guys are probably pushed, and there's sort of a window of opportunity here. So why don't I just crack on with what I put together for you?
Please do.
Okay, so a little bit of background about me very quickly. I've got a master's in engineering from Imperial, which Stel will know. It's the UK equivalent of MIT.
I went to Imperial as well, by the way.
Yes, I know you did.
Yes.
I'm a few years older than you, though. And I've been around the business a long time. I've worked for various of the great and the good, primarily as a prop trader. I've run various hedge funds. I've allocated to hedge funds as well. Sat on the boards of a number of different funds and firms. My I've traded pretty much everything during my career: equities, fixed income, currencies, commodities, and I've been trading derivatives since 1987. So I have quite a background in terms of markets. I'm now actually semi-retired and have been for a few years. But I still advise a handful of the world's biggest hedge funds and asset managers on global macro and long short equity portfolios, and been consistently ranked #1 in the world for what I do. So hopefully I can share some of those insights with you today. I use what I call a techno-quantum mental investment process, and I think it's really important that everybody understands what their own investment process is. So first of all, I start out with a global macro view of the world in terms of a big picture view on growth, inflation, rates, what the central banks are doing, and don't get me started on central banks. That's my key bailiwick. And then I apply various proprietary screens and come up with some themes or thematic ideas about the world and what I want to look at. And then once I've screened the universes of assets that I want to look at, I then look at technical analysis, which is why I like listening to what you guys do, and you do a great job. So here's my track record, or my credentials, if you like. I typically aim to for the hedge funds that I work with, I typically aim to make about 10% a quarter in terms of alpha. And that's what we call dollar neutral, or you extract all the market risk out of your portfolios. I do also run a very, very strict market neutral book for one of the biggest hedge funds, where there's literally only stock specific risk in the portfolio. But this is the track record for the opportunistic long short, which I run for a number of hedge funds. And there you can see sort of P&Ls that we run in terms of, that's one of the portfolios. So I guess one of the reasons why I got invited on is I'm sort of fairly well known in the community for my macro calls. And Stel will probably remember this. Back in 2020, I called the low on interest rates as well as the low on stocks at the time. And I said then, and I've said for the last 4 years as well, we are now in a generational bull market for inflation and for yields. And although we may get pullbacks along the way, the trend of least resistance is upwards. And I do believe that that's going to take place over the next decade plus. So I don't think in my lifetime, I don't want to do a Janet Yellen, but I don't think in my lifetime we're going to see rates as low as we have, back in 2021. So here's a couple of the ideas that I think we talked about last time I was on. This is going back to November of last year. We were looking at silver, and we basically said we think it's going to be going much higher during 2024, and obviously that's played out quite nicely. I still don't think we're finished. I think we still have higher to go. In fact, we could have a lot higher to go. This is something else that we were looking at the time, which is the ratio of small mining companies to large mining companies. And generally speaking, when small miners are outperforming big miners, it's generally a bullish environment overall for mining stocks and for metals. So that was something that we were looking at the time, and just to reinforce our conviction. And by and large, we tend to look for lots of different things pointing all in the same direction before we jump onto ideas or trades. And here's another example of that. We looked at, the gold-silver ratio chart, which I guess other people look at as well. But when this is breaking down or going lower, it means that silver's outperforming, which again is another pointer to a good environment or a bullish environment for metals, and therefore also mining stocks as well. We've also been on the copper trade. For the last couple of months. I did tweet about this while I was having a little holiday a couple of weeks ago. Because I was on vacation, I actually got out too early. We rode it up from $4 to about $4.70 in the space of about 6 weeks. And I think Stel saw me tweet about it on X. I was,
Yep.
actually on vacation at the time, and I thought, we made a good amount of money, and I just want to enjoy my vacation. So we actually got out too early, but we have been on the bullish side for most of the metals and mining companies. Here's an idea that we put out at the end of Q1, which is short cocoa, and it's the same for everything in financial markets. When you get parabolic charts, doesn't matter what it's in, but you see it more often in commodities and I guess meme stocks as well. When you get parabolic rises, it inevitably ends in failure. It's just a question of timing. And with this short cocoa trade, I think I said at the time, you have to have deep pockets. You have to have it as part of a portfolio, as a small position size, because I think a lot of younger or inexperienced traders try to do is they try and swing for the fences, and they put position sizes on too big without realizing that things can go against you, and what you don't want to do is get yourself stopped out of a trade. I mean,
Dale, can I interrupt you here? And
Yeah.
you said something really particular, which I 100% agree. I mean, not knowing exactly, I could barely even read exactly where it went, but cocoa, it may have gone maybe another 10 or 20% higher, but it's obviously reversed quite aggressively since then. Yeah. And you said that a lot of these types of moves, which I 100% agree, happen in commodities, but we're in a different regime now than we were 10, 20, even 30 years ago. And do you think the same rules still apply in the commodities market, or are we going to have a prolonged commodities rally moving forward? What are your thoughts there?
That's a great question. I'm going to come on to that, and I'm in the latter camp. Because of my core belief that we're in a generational bull market for inflation, I do think most of the ideas that we're working with right now in the portfolios are long inflation trades, which by definition means long commodity type trades as well.
All right, very good. By the way, Stelios had to bow out. He wanted to say goodbye, but didn't want to interrupt you. So
no worries, I'll catch up with him. Here's another trade that we've been on the last couple of months. My nickname, by the way, is DB Noble for two reasons. Number one is I don't take any BS, and number two is I make quite a lot of money over the years from being short. So I'm a short seller by nature. Has a tendency to, I guess, to arise from the fact that I started out life in the markets in the 80s, and one of the first big experiences I had in 87 was a stock market crash where we lost 20% in a day. So you tend to develop your market trading skills from the environment that you're in when you're first starting out in the business. So
Dale, I hate to interrupt you, but it's funny. I was just having a conversation with Jared Dillian, who's the editor at the Daily Dirt Nap, just last week. He was saying something similar on Real Vision, and I am a product of the .com bubble and blow up. So I 100% agree. You're a product of what environment you were brought up in. You were brought up in the late 80s through a crash. I was brought up in the .com bubble. So through a crash really is when, I matured more into my late 20s. But I always, since I made so much money on the short side, I tend to lean that way too. And Jared was saying he did the same thing because of the .com bubble. So that statement rings true with myself. Which will also be really interesting. 2 generations from now, or a full generation of traders from now, are going to always lean probably to the bullish side. And ironically, we might be in a market that's in more of a consolidation.
I agree 100% with that comment.
Yeah. Okay. Anyway, I just thought
So the point about this slide that I was trying to make was, historically I've made a lot of money on the short side, but in recent times I've been bullish pretty much everything because of the environment that we're in. So we were long DAX, we're still long a little bit. We took half of it off. And, you know, I've been one of the most vocal people speaking out about cryptocurrencies. You know, I can't profess I understand them or understand the use case for them. They're just another risk asset as far as I'm concerned. And to that extent, you know, you need to be trading things like they are an inflation hedge. And so, you know, we've also been long of Bitcoin in recent weeks, and that's gone pretty well. So we're looking at, you know, potential drivers going forwards for markets. What are the thematic drivers? And as I think you've already said, Blake, you know, what are the views on commodities? And the view is, given what the Fed has done over the last 2 decades, and if you follow me on Twitter, you'll know my beef about the Fed and what they've done. We have an excess of capital in the system, and it's manifesting itself in all sorts of ways. In the politicians and the economists can talk as much as they want about, oh, things are slowing down, inflation's coming down. It's absolutely hogwash. So our view is that things are destined to go higher. Commodities such as uranium, we've looked at and we've had investments in. Silver, you know, we've been in the precious metals. I think silver's going higher, potentially much higher. Even the soft commodities are following suit now. You're getting sort of wheat and corn sort of looking like they want to go higher. The thing that I guess a couple of points I'd make is I'm a little bit confused at the moment. I've been a big believer in higher rates, and I still think that's the case much longer term, and probably a stronger dollar as well, because, you know, obviously higher rates drives the dollar on a relative basis anyway. But a couple of things are perplexing me. One is we may have had a failed breakout of the US-German yield spread. So that potentially is suggesting a weaker dollar, although I still can't get my head around that right now. And if that is the case, if it is failed, it has huge implications for asset markets, you know, yields, currencies, equities. It has major implications. And I still think we're on the fence with that right now. We have to sort of wait and see for, you know, a few weeks, maybe a couple of months to see how that pans out. And the other thing is, I've been looking at the yield curve in the US. I do believe that we're going to get a curve disinversion, meaning that short rates are going to come down and the curve is going to flatten and go flat.
That's usually a precursor to a recession, or like right on the cusp of one, right?
Yes, exactly. And historically, that's been a bad omen for stocks. It's not happened yet, so I'm still playing a waiting game on that. And I think those two things with the yield curve, we need to keep watch on quite carefully.
Yeah.
But failing that, I think the building blocks are in place still for risk appetite to be in markets. And I think you pointed that out already. There is still no clear sign that we're getting a breakdown in risk assets, as, you know, the growth of the value ratio suggests. So coming back to my pet chart, going back 50, 60 years of inflation, I've said this for a long time now. Once you let the cat out of the bag, you cannot get it back in. And the Fed have manipulated interest rate markets for so long that eventually you had to start showing up somewhere. And that, you know, that manifested itself post 2020 with inflation. I think inflation is...
I was gonna just, I want to ask a question here, because I'm with you on this, but like you're seeing, and I'm just speaking directly to the US, what we're seeing here, you got companies like Target and McDonald's specifically, just over the last week, they've talked about they're going to be dropping their prices. Do you think disinflation or even a deflationary spell is even possible? Because I'm with you on what you're seeing here and what you're showing here. I just wonder if demand falls off the cliff because of high prices, we could actually get into a deflationary type of environment. But love to hear your thoughts here.
I don't think we're going to get deflation. If anything, if anything, I think we're more likely to see stagflation.
Okay.
And I think disinflation is all very well and good, but you look where the baseline scenario is, and we're much higher than we were, 20 years ago, right? And I don't think that's going to come down. And as long the Fed have missed a trick, right? They've missed a trick. Raising interest rates has only hurt the guy on the street. It hasn't hurt, it hasn't hurt the wealth effect for the people who have lots of money. And what they should have been doing is extracting liquidity from the system instead of raising interest rates as high. And that would have been fairer for everybody. But as
100% agree.
As we're seeing now, asset prices across markets, across all asset categories, are supported because of the excess liquidity in the system. And the Fed are now talking about, slowing the pace of QT, potentially coming to an end in the not too distant future. That's going to support asset prices. And I don't see how inflation can move lower on the back of that. Commodity prices are going up. So input prices are going up. So I can't see that we're going to have disinflation or deflation.
All right. Great answer. Thank you. I feel the same way.
Yeah. So here's what we're looking at. We run two main strategies. One is a global macro strategy, and the other primarily is what we do. Our bread and butter is long short equity. So we're looking at, and I think I spoke about this last time I was on, how I want to be short things that are linked to interest rates, because I don't think interest rates are coming down anywhere near as quick or as much as people might like. I think because of the inflation that's embedded in the system now, that's just not going to happen. So we like to be short things that are sensitive to interest rates, and we like to be long of things that are linked to what we call inflation trades. So, we think that energy prices are going higher, right? So Consol Energy, it's a coal company. Carpenter Technology, that's a specialty metals and minerals company. We like these sorts of trades because inflation is not going away anytime soon. We've obviously been long gold and mining stocks for a while. Here's a couple of them that we've had in our portfolios. Uranium, another driver of inflation. We think that uranium prices are going higher and energy prices are going higher. Oil, we've been looking at oil stocks. I've been banging on about this for the last 3 months now. I think there's going to be a huge rotation out of things like technology, telecoms, some of the other tech sectors. We've been short a whole bunch of solar plays, and we've been long of oil stocks. So we really like that sector and that switch. And we think, I'll come on to something in a few seconds, and I'm not too far away from the end of the presentation now, but we do think that this trade will take time to play out, and there's going to be pullbacks along the way. As I said, with inflation, it's a multi-year, potentially decade plus type of trade, and timeframes are important. You have to remember that. You guys, I know, are very much focused on some of the shorter term trades in FX markets. And I started out life as actually an FX trader back at Lehman Brothers in the 80s. So I'm on board with that. But for what we do currently here, we look on a longer time frame.
Yeah.
So Bitcoin, I really don't like Bitcoin all that much, but you have to trade what you see in front of you. And what we see is inflation, and we see asset prices supported by too much liquidity, which means things will get driven higher. So we've been long of, Bitcoin mining stocks. We've been long of, Coinbase, which is obviously an exchange for cryptos. So those are the sorts of things that we've been looking at. I specifically haven't put anything in the presentation about our short positions, because in our opportunistic long short fund, we're dollar neutral, which means for every dollar of longs we have to have $1 of shorts. And We don't usually like talking about the short sides of our trades for a number of reasons. Number one is, for compliance purposes. Number two, the hedge funds that I work with, pay, fairly hefty premium for this sort of advice. And the third thing is, we don't get caught out in any short squeezes. So, because the positions we hold are fairly big, our typical ticket size is, between $5 and $10 million. So, I'll just finish off with this slide, and this is going to address some of your questions, maybe, Blake. I'm not selling anything, and this is not investment advice, and please don't construe it as such. I'm semi-retired. I only work with a handful of clients, and I don't need to sell anything online. So take that for what it is. You don't survive in this business for very long unless you have what I call depth. And by that, I mean diversification. So the point I will make about this is that no single position in my portfolio is more than 5% of the portfolio. And diversification can save you from a myriad of sins. It saves you from getting too big on a position. It saves you from doing something stupid like doubling down. You have to have diversification. If a single position is too big and it goes wrong and it wipes out your whole month or your whole quarter or your whole year, or maybe if you're very, very concentrated, your whole portfolio, don't get into that position. You want to be in the business a long time, whether you're doing it as a career or whether you're doing it just to manage your own portfolio. Einstein, so Einstein, is known for his various theories, his quantum theory of light, his special theory of relativity, his general theory of relativity, blah 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 blah. But one thing that Einstein said is time is an illusion, and what I mean by that is time frames are relevant to the individual. So your viewers, your subscribers, they might have a very short-term time frame. They might be trading off a 5-minute chart or an hourly chart or a 4-hour chart. Everybody's time frame is relevant to them. We operate on a much longer time frame. We look at macro themes that are generally going to be in place for many months or many years in some cases. And our portfolios, my typical time frame for a trade is probably 3 or 4 weeks at the shortest. We will have a fairly high turnover of our long short book, but time frames are important. So understand your time frames. Don't expect you're going to make 20% on a position in a few days. If the market allows you, great, but be patient and understand what your time frame is. Probability, okay, this is important. I'm ranked number 1 in the world for what I do, or there or thereabouts, quarter after quarter. But I'm only ever right probably 60 to 65% of the time, which means that 1 out of 3 trades that I put on, I'm wrong. And I think people starting out in the business think they have to be right all the time, or they want to prove that they're right all the time. And I remember when I first came in the business back in the 80s, I thought I was super smart and I wanted to show everybody that I was working for at the banks, I'm the smartest guy on the trading floor. I wanted to be right 100% of the time. It doesn't work like that. And you need to understand that, and you need to take that in and absorb it. You're never going to be right 100% of the time. And even if you're right 60% of the time, you can still make a lot of money. It's all about managing your risk, letting your winners run, cutting your losers quickly or relatively quickly, and understanding that you're not going to be right. And that's just the way of the world. And then I put to fit with the acronym, I've put T for thoroughness, but what I really mean here is process, but I've already got a P in probability. So so thoroughness. I know what my investment process is. I know what my style is. I know what my process of understanding the macro environment is, drilling down from that in terms of doing some screening, coming up with themes that I want to follow and implement in the portfolio. And you have to do that time and time again. And this is coming back to the probability. Knowing that I'm only right 60 to 65% of the times, when I'm wrong, I just kick that trade into touch. I just kick it into touch, get it out of the portfolio. It's not going to help you. Don't double down, just get rid of it. Take the loss, move on. Thoroughness. You've got a process. Go back to your process and go through it again and find another idea. Okay, it's very, very simple. It's investing is a very boring business. I mean, I have a lot of fun, to be honest, but it is a very boring business in respect to the fact you have to have a process and follow that process. And then finally, humility, understanding all of the above, right? If you understand all of the above, know that you're going to be wrong. You're only going to be right 60% of the time, even if you're very good. And just accept the fact that the market will give you what it wants to give you. The market's not beholden to you. If you're wrong, you're wrong. Just get out. Say, oh, you know what? I got it wrong. Get out. Try and run your winners as long as you can. And funnily enough, I find that harder than I do cutting risk. Once something's not working for me, I boot it out of the portfolio.
I 100% agree with that.
But letting things run, like the copper trade, right? And maybe because I was on holiday, we got out, we'd made 16, 17% in the space of 6 weeks, but we got out. And what we should have done is we probably should have taken some of it off and let the rest run. So it's all a process. Anyway, that's probably what I wanted to say to you today. I hope it's been informative and enjoyable for you. That's where you can reach me. I'm not looking for billions of people to follow me. I'm not selling anything. I don't have a website, but I'm happy to see people on Twitter and interact. I know you guys do a great job. And one last thing before I go, Blake. I know you have a mentoring program where you are helping people in the community. Because I love what you guys do, and I'm very proud of what you do to help the wider community. I'd like to offer free of charge, and you do it how you want. I will offer myself 1 hour per quarter, so just once a quarter, for one of your subscribers to do an hour session with me if they want to do that.
Dale, that's a really, really nice. That's really generous of you. How about I'll circle back with you privately, and we can talk through the details. Dale, I was really impressed with your presentation. Now, like I said, from earlier, last time or the very first time you were here, I remember being able to sit through a bit of your presentation. I want to say really great information. I wanted just to comment on a couple of things you just said, though. The talk about the probabilities. I mean, you can actually even look at our 7 years of keeping tabs on our whole entire team, not me, not anybody in particular, our whole entire team. We're right on 52% of our ideas, but we're still up substantially over the course of 7 years. So that just shows you you don't have to be right all the time, and it goes to what Dale was saying. And also, when you said diversification, I want to ask you this, Dale, really quick. We're in a market where so many assets are just moving together in unison. It's like one market. It doesn't matter if you're trading notes or the dollar or precious metals or equities. They all move together. Has that posed a challenge for you from a diversification standpoint over in recent years?
No, it generally doesn't. What you tend to find is in periods of market stress, periods of market stress, correlations 10 to 1. So diversification then is kind of a moot point because everything moves together when things are crashing. What you then have to do is be able to identify that you're in that sort of an environment and have some kind of cheap protection somewhere in the portfolio. I'm talking about the macro book now. Not so much. It doesn't matter so much in the long short book because for every trade that we have on, every long position we have on, we have a short position against it, and we typically run 25, 30 positions in the portfolio. So we're never really, we don't have any underlying market exposure because we're dollar neutral, and we're sufficiently diversified across different sectors and so on. So but yeah, I get you. I get what you're trying to get at here. At the moment, things are all moving up together, and that is an unusual environment, but that's just a function of the fact that the Fed have created a monster.
They have.
At some point, it may well implode. I think you'll get some warning of that because volatility will start to pick up, and then when vol starts to pick up, that's when you probably want to do things like scaling back your position sizes, top slice the portfolio, maybe buy some out of the money protection, and maybe take some positions off entirely, especially the more volatile positions.
I think we have a wild several years in front of us, Dale, and I'm sure you'd probably agree with that based on your experience and what we've seen in recent decades, or over the last several decades, and what we've seen in recent years. We're gonna have to really strap on our seatbelts soon.
Mine's been on for a while.
All right. Well, I'll be sitting right next to you, my friend. Dale, I want to say really, really nice hearing you. And I'm going to circle back with you regarding your very generous offer, because I think you are really a blessing to have here. So thank you so much for your time today.
My pleasure. As I've said to you guys in the past, I think you do a fantastic job, and keep up the good work. I think that the people in the community that work with you, are benefiting greatly from what you're doing.
Thank you, sir. Really appreciate you. All right. Well, Dale, like I said, I'm gonna circle back with you personally. Thanks again for your time today. It's been wonderful, and I know you should just, if you haven't had a chance to read some of the comments that have been coming through this chat, people are just very, very thankful to have you here. So, and I am too, as well.
You're more than welcome.
All right. Well, Dale, have a great one. Everybody, thank you so much for being here today. Remember, unemployment claims have been moving the markets the last couple of weeks. That's going to be highlighted tomorrow. So make sure you're around for that. We'll be covering that, as well. And then, tomorrow we'll have a boatload of PMIs coming through most of the world. So you guys hang on to your seats and buckle up, folks. It's going to be a ride. Thank you, Dale. Thanks, everybody, for coming in today. And we'll see you tomorrow on F.A.C.E.
Thanks, guys.
Thanks, Dale.